Hey everyone, welcome back to Corporate Decoder, where we try to make financial filings less of a snooze fest. And boy, do we have a filing for you today. Equitable Holdings Inc. is dropping their latest quarterly report. And let me tell you, there are some numbers in here that might make your eyes water or maybe do a backflip. So buckle up because we are diving deep into their Q3 2025 report. Before we jump in though, if you appreciate getting straight talk and real insights from these dense corporate documents, do us a favor, hit that subscribe button. And hey, if you want to chat about this filing or any others, join our Discord community. It's linked in the description below. We'd love to have you. All right, first up, the balance sheet as of the 30th of September 2025. Their total investments are sitting at a hefty $116.5 billion. That is a lot of money invested, but here is a kicker cash, and cash equivalents are showing a significant jump to $13.6 billion. This is a big increase from the $7 billion they had at the end of 2024. Think of it like this, they suddenly got a lot more cash on hand. This could mean they are preparing for something big, or perhaps they are just being extra cautious in what might be a shaky market. Now, liabilities side a massive $129.5 billion in policyholders' account balances. This is their biggest liability by far. Essentially, this is what they owe back to their customers, and it has grown quite a bit since last year end. When we look at the bottom line, things get a little bumpy. For the 3 months ending the 30th of September, 2025 net loss attributable to holdings was a huge $1.3 billion. That is a big change from the previous year's 9-month period where they actually had a net income of $388 million. This shift is significant and definitely warrants a closer look. One of the biggest pain points impacting their income is investment losses. For the 3 months ending the 30th of September, 2025, their total investment gains and losses were a negative $1.17 billion. This is a massive swing compared to the same period in 2024 where those investment gains and losses were only a negative $46 million. This huge drop is largely due to assets transferred in a reinsurance transaction with RGA. Let's talk about how they make money initially. Premiums are a key part of their revenue, and for the 9 months ended the 30th of September, 2025 premiums brought in $822 million compared to $879 million in the same period of 2024. It is a slight decrease, but not too alarming on its own. Now, for the expenses side, policyholders' benefits are a significant chunk of their outgoings. For the 9 months ended the 30th of September, 2025, these benefits amounted to about $2 billion, a slight decrease from 2024's $2 billion. It is good they are managing these costs, but remember this is impacted by things like mortality rates and customer behavior changes. Now this is where things get really interesting. Equitable Holdings uses a measure called non-GAAP operating earnings to give a clearer picture of their core performance. For the 9 months ended the 30th of September 2025, this figure was $1.2 billion, a drop from $1.5 billion in the same period of 2024. While the GAAP net income shows a big loss, this operating earnings figure seems to tell a slightly different story. They are trying to say that when you strip away all the accounting noise and market ups and downs, their core business is still chugging along pretty well. Let's break down the business segments. The retirement segment is their biggest player. For the 9 months ended the 30th of September, 2025 operating earnings here were $1.1 billion, a slight decrease from $1.2 billion in 2024. This segment seems to be the rock of the company, showing consistent profitability. Next up, asset management, which includes AllianceBernstein. Operating earnings here increased nicely to $411 million in the first 9 months of 2025, up from $318 million in 2024. It looks like their investment strategies are paying off, especially with higher average assets under management. Wealth management is their rising star. Operating earnings in this segment grew to $154 million for the first 9 months of 2025, up from $135 million in 2024. This segment's growth is fueled by increased advisory fees and distribution revenue, which is a good sign for their future. Then we have corporate and other, which includes things like the closed block of life insurance business and other unallocated costs. This segment is deep in the red with operating losses soaring to $466 million for the first 9 months of 2025, up from $172 million in 2024. This segment is a drag on their overall performance, mostly due to that big reinsurance transaction with RGA. The balance sheet's accumulated other comprehensive income shows a significant negative number of nearly $6.2 billion on the 30th of September. 2025. A lot of this is driven by unrealized losses on investments, particularly fixed maturities. This means that while they haven't sold these investments, the market value has dropped significantly. Looking at their debt picture, long-term debt stands at $3.8 billion. It has stayed pretty flat year over year, but they did issue $500 million in junior subordinated debt securities in March 2025. This is a form of financing that is a bit riskier, and thus usually comes with higher interest rates. Now for the risks. The filing mentions a whole host of legal and regulatory matters, lawsuits about sales practices, agent misconduct, product design, and UN unclaimed property. They say they cannot estimate the range of losses for all of these, but they do estimate up to $100 million in reasonably possible losses beyond what they have already set aside. It sounds like a potential headache that could pop up later. So here is the deal with Equitable Holdings. GAAP net income shows a pretty ugly picture with a significant loss. However, their non-GAAP operating earnings paints a much brighter picture showing solid profitability. This tells us that all the market volatility, the changes in derivative values, and those big adjustments from reinsurance deals are really distorting the core business performance. It is like looking at a car's MPG with and without the engine running the operating earnings. Is the engine on? Number, the core business looks healthy, especially retirement and asset management. Their move into wealth management is showing good growth, which is promising. The main weakness is that corporate and other segment, which is bleeding cash largely due to that reinsurance deal. They are also carrying a lot of unrealized losses on their investments, which is a bit concerning in this market. But overall, they seem to be actively managing their risks and their core segments are performing. Alright, that is our breakdown of Equitable Holdings' latest filing. What do you think about these numbers? Are you buying into the operating earnings story or more concerned about the gay ape numbers? Let us know in the comments below. If you found this analysis helpful, make sure to smash that like button and subscribe for more deep dives into corporate finance, and don't forget to join our Discord community linked in the description. Thanks for watching, and we will see you on the next episode of Corporate Decoder.